Hey investors, this is the Young Investor Guy. So, the oil market has plunged into negative territory. All the news and media outlets are hyping about negative oil. As a long-term investor, the question now is it time now to start considering oil as an investment? Now again, please be sure to like the video if you enjoyed the content. I would really appreciate it. Now, let's get it started. Before we get into oil investment, let's review all the facts we have first. When the news media is talking about negative oil, they are actually only talking about the futures contract for the month of May. So these futures contracts are only for the month of May, not for June, not for July, not for August, not for September, okay? Only for the month of May. Now usually these options contracts have an expiry date. They usually fall on the third Friday of the month, or they could be at the end of the month. In the case of WTI Crude, the contract expires on April the 21st. At the time of this video, it's April the 20th, which means there's only one extra day left before the contract expires, which also explains why there's a lot of activity today, driving the price of May contract down to negative territory. To back things up a little bit, let's talk about what a futures contract means. A futures contract is to buy or sell a particular commodity at a predetermined price and at a specific time. So for example, if the oil futures was at $20, that means the buyer and the seller agrees to deal at this $20 price in the near future. So now you ask, why do they want to fix the price or lock in the price in advance? Well, let's say if the buyer anticipates there's going to be an increase in demand. And when there's an increase in demand, that means the price of oil is going to go up. If the buyer knows the price of oil is going to go up, they may want to secure a price and lock down that price in advance. As an example, if the price of oil does go to $25, that means the buyer wins because the contract stipulates that the buyer will be able to buy that oil at $20. On the other side, if the buyer anticipates there will be no demand and the price of oil will be going down, the buyer may not want to secure the contract at $20 since it knows it may go even lower. Instead, they may be even hedging on their potential losses by trading and betting on that oil prices will go down. In a situation right now, the price of oil is negative. What does that mean? It means that the buyer does not anticipate any demand for the month of May. Well, since the buyer doesn't want any oil, the seller would have to actually try to get rid of all the oil inventory that they have. So you ask, why do they want to get rid of the oil inventory? Why can't they just store it and just wait until demand gets better and then start selling them again? Well, that's not how it works because it'll cost money to actually store these oil barrels. And as you can imagine, these are huge barrels and they take a lot of space. Just as we're talking this second, we're losing space and storage. There's just too much oil. So you ask, why can't they just stop pumping the oil and just store these the way they are and wait until demand picks up? Well, that's actually not how it works in the oil market because there's simply a lot of costs associated to run all the wells and pumps. If they want to shut everything down, there's actually a lot of costs associated with that. The reason is because shutting down the oil patch isn't as easy as just flipping a light switch or giving this video a like. It actually costs a lot of money to shut everything down. So instead of shutting down all the wells and everything, it might make more sense for them to actually just get rid of the oil, pay someone money and say, hey, get rid of these. So these producers will actually have to pay to get rid of their inventory. That makes sense because even when we dump our old furniture, we have to pay the movers to get rid of them. The stock market is forward moving, so just looking at the May contract may not be a good indicator of what's happening in the oil market in the big picture. When we look at June and July numbers, it looks like these prices are still holding up above the $20 mark, so it's not all doom and gloom just yet. This is because buyers are anticipating there will be more demand for oil in the upcoming months, say in the months of June and July. People will come back to work eventually and actually consume a little bit more oil. Whether this is true or not, this is still a wait and see scenario. In terms of investment, there has been a lot of talk on a popular fund like the USO. Is the USO a good investment for the long term? In my opinion, the USO would actually not be a good investment due to their rollover effect. This is because USO is a fund, okay, and they buy contracts and sell contracts. They actually don't want to get physically involved with the oil delivery itself. If you're buying an oil company, they actually deal with the physical delivery, okay? They buy and sell oil. But if you're buying the fund, you're actually not touching oil at all. You're just a trader. You're trading the contracts. So in order to avoid these delivery, USO has to actually rebalance by selling futures contract and buying futures contract constantly to ensure they don't have to meet the physical obligation. So in this situation, they actually have to sell their futures contract for the month of May at a loss, and then perhaps purchase the month of June and July contracts at a much higher price. A better alternative would be DBO, Invesco's version of playing the oil market for the long term. This is because the fund uses a strategy and selects a futures delivery within the next 13 months, instead of just rolling contracts over into the month of June and July. This is done by following a DBIQ Optimum Yield Crude Oil Index. So in other words, DBO is kind of like following the index, whereas USO is just following directly on the futures contract on NYMEX. Considering the big plunge in oil prices in the May contracts, we haven't really seen a significant drop in companies like Exxon and the Chevron. This shows that investors still do have faith in these big oil companies and know they will be able to actually hold on. At the same time, for a lot of smaller and oil drilling companies, they may just go bankrupt. That is why it is so important for you to be very selective in the companies you choose at this current time. Another safer way to play this would be just buying Spider's XLE ETF or Vanguard's VDE ETF. In my opinion, the oil market may still get worse before it gets better. However, if you do have a longer horizon, like 3 to 5 years, and if you believe that demand will eventually pick up when everything goes back to normal again, then you'll have a pretty good chance of winning. Please be sure to like the video if you enjoyed the content. I would really appreciate it. Again, I'm not a financial advisor. These are just my opinion towards the stock and towards the market. Please invest carefully at your own discretion. Thanks so much again for watching, and I'll see you next time.